Most people look at a short-term rental and only see the cash flow. What they're missing is that the real money is often in what you don't have to pay in taxes. This buyer purchased a second home property in Long Pond, Pennsylvania, which is right in the heart of the Pocono Mountains. And the financing here is only half of the story. The tax strategy behind this deal is what makes it a serious wealth building move. Let me break down the whole thing. What's going on, guys? Welcome back to another Deal of the Week video. If you're new here, my name is Ricardo Carrillo. I run RC Lending Advisors. We're a nationwide mortgage lending company that helps clients all across the entire US get financing for both residential and commercial deals, whether you're buying your first property, whether you're buying your first investment, or you're scaling your real estate portfolio. My team and I will walk you through the entire process from A to Z. The whole point of these videos is to show you real deals, real numbers with real clients, and exactly how they're structured so that you understand what is actually possible when you do this the right way. This property was a purchase that we did in Long Pond, Pennsylvania, which sits right in the Pocono Mountains. And I want to walk through two major things that happened on this deal. The first one is I want to walk through how the financing was structured and the tax strategy that makes a property like this so powerful for the right buyer. Because when you combine both, this stops being just a vacation home and it starts being a real financial tool. So let's just jump right into it. This property is a single family home, 1,092 square feet, 3-bedroom, 2-bathroom house sitting on just under half of an acre. It has a smaller footprint than some of the other properties that we've broken down in this area before, but that actually works in your favor from a tax strategy standpoint, and I'm going to explain why in just a minute. The purchase price was $355,000. We did a 10% down payment with a conventional loan done as a second home property. The loan amount came out to $319,500, and we were able to lock in a 30-year fixed interest rate for our client at a 7.25%. Principal and interest on this would come out to $2,179 a month. The homeowner's insurance, which we also have to pay for, unfortunately, is $121 a month. Property taxes here in this market between county and school taxes came out to $211 a month. The monthly PMI, or private mortgage insurance, on this deal was $63 a month. That's very low. And the HOA in this market was $103 a month. That leaves our total monthly payment at $2,679. Now, I want to pause here for a second before we get into closing costs, because I want to talk about something that most people in real estate completely overlook when they're evaluating a deal just like this, and it's actually the tax benefit. Now, I'm not a CPA, but I do work very closely with a lot of CPAs who specialize in real estate and tax planning, and I've seen firsthand how the right tax strategy can completely change the financial picture, not just on an investment property, but more specifically on a short-term rental. So let's walk through a few things worth knowing, and then I'm going to tell you how to get connected with the right people if you want to go deeper on it. The first thing that people need to understand is depreciation. When you own a short-term rental, the IRS will allow for you to depreciate the value of the structure over 27.5 years. What does this mean in simple terms? It means that in every single year, you get to deduct a portion of the property's value from your taxable income, even if the property is actually going up in value, which we know most properties do year over year. You're showing a paper loss on your taxes while the asset is continuing to appreciate in the real world. And for a lot of investors, this depreciation deduction alone will offset a significant portion of the income that the property generates. It just means that you could be cash flowing from the rental and still show little to no income, taxable income, from it on paper. Now, here's where things get even more interesting. There's actually a strategy called a cost segregation, where this kind of takes it a step further. Instead of depreciating the property over the entire 27.5 years, a cost segregation study will break down the property into its individual components, things like appliances, flooring, fixtures, landscaping, and other personal property could also be depreciated over a much shorter timeline, sometimes 5 to 7 years instead of 27.5. So it's kind of an accelerated depreciation. And when you combine a cost seg with bonus depreciation, which allows you to front load a large portion of that accelerated depreciation into the first year that you own the property. You create a huge, significant tax deduction in year one. Now, for the right buyer, this can offset income from other sources, like your business that is already doing phenomenal and you have a lot of taxable income, or what are your W-2 job, for example, and it will dramatically reduce your overall tax liability for that year. This is why short-term rentals have become so popular for a lot of individuals, not just from a cash flow standpoint, but also from a tax savings standpoint. Now, I do want to be clear though, because these strategies are not a one size fits all. Whether a cost segregation or a bonus depreciation makes sense for your specific situation depends on your income, your tax bracket, how the property is classified. There's a number of other factors, right? This is why I always recommend my clients to work with a CPA who specializes in real estate. Now, I have CPAs I trust and refer clients to regularly. If you need a recommendation after watching this video, you can 100% reach out to me directly. I'm happy to point you in the right direction, because the right tax professional can look at a deal like this and show you exactly what's possible in your situation and how much money you could be saving at the end of the year. There is one more thing that I do want to mention that a lot of people have never heard of, and it's called the Augusta Rule. Now, under section code, or IRS section code 280A, if you rent your primary residence or your second home for 14 days or fewer per year, that rental income is completely tax-free. You don't have to report it. This was originally named after Augusta, Georgia, where we've actually done a lot of houses. We've actually helped a lot of people buy real estate there. Augusta, Georgia, because of the homeowners near the Masters golf tournament, they were renting their homes out for a week and not reporting the income. Now, because of this, the IRS ended up coding it and made it a legitimate tax strategy. Now, for a full-time short-term rental, like the majority of my clients like to use, the rule by itself is not going to be the main play. But if you are renting the property, but most people who have it on Airbnb, they're going to be renting it for more than 14 days. But it is worth knowing that this rule exists, and it's worth talking to your CPA about and how it might apply to your overall situation or your overall strategy, depending on how you structure ownership and usage of the property. This is something that a lot of my investors do with their primary residences, not always with their second homes. The point of all of this, though, is that when you buy a property like this correctly and you have the right team around you, you're not just buying a short-term rental, you're buying a tax-advantaged asset that generates income, builds equity, and also potentially reduces what you would be owing Uncle Sam every single year. So that combination is what makes serious investors buy in markets like the Pocono Mountains, and it is why the cash flow alone is never the full story. Now let's get back to these numbers and finish the breakdown. Total closing costs on this deal came in at $17,348. The seller contributed $2,000 in seller credits. There was also $1,300 in adjustments and other credits, which came in at closing, and that's from other county taxes, school taxes, and HOA that the seller had already paid for through the end of the year. So those credits come directly off what the buyer needs to bring to the table. And so if we take these out, after everything was accounted for, the total cash to close on the deal came in just a little bit above $58,000. That was the total down payment, plus all the closing costs, minus those seller credits and those adjustments. 10% down on a $355K property in the Pocono Mountains, legally operating as a short-term rental, with a financing structure that keeps more capital in your pocket and a tax strategy that can work in your favor for years. That is how you buy smart. Now, if you want to understand what second home financing looks like for your specific situation, or you'd like to get connected with a CPA who specializes in real estate and can walk you through the tax side of a deal just like this, go to rclending.co, where you can find me on my Instagram at Richie the Lender. My team and I work with buyers all across the country, and we make sure that you have all of the resources and all of the right people at your disposal around you to make sure that you do this the right way. I appreciate you guys for sticking around and watching. If you haven't had a chance to see my other Deal of the Week videos, you should go check those out. You can either click right here or click here. I will see you guys in the next Deal of the Week.